Hello and welcome to the show. Today we have with us Rajiv Lall at the occasion of the launch of India's newest bank, IDFC Bank. So good to have you on the show as you're making this big transition from an infrastructure-based lender to a full-fledged universal bank. What is the kind of change in the DNA that your organization has gone through?
So at one level, not much of a change. At another level, a very fundamental change. The sense in which there is no change to the DNA is really, if you characterize it as the sense of purpose and the sense of building an institution, I'd like to believe that people at IDFC are imbued with this DNA of actually wanting to build something that is of value to the community, that is lasting, that makes a difference in people's lives. So just the same passion, drive we brought to building the infrastructure business, that same DNA will be at work to bring to life a bank. In other ways, the DNA is changing radically because in a pure business sense, we are navigating now a transition that will take us from dealing with large-ish and very large corporate customers to ubiquitous retail. And that means an appreciation and an understanding and a nurturing and building of a service culture, the characteristics of which are going to be very different for us. So that's very exciting.
Yes, and of course the entire banking system is going through a very exciting time, is going through a huge transformation at the cusp of many changes as we can call it right now. Now we have seen that a differentiated model is the call of the hour. We have small banks, we have payment banks, apart from the already existing banks that we have in the banking system. What is it that is going to be your key focus which will differentiate you from the other banks as the executive vice chairman and the MD of IDFC Bank? What is it that you are going to look at?
So it's very simple and it's very complex at the same time. What is a bank? A bank fundamentally is a service organization. A successful bank must be able to deliver service of quality with a certain consistency and reliability to all the customer segments that it's striving to serve. What we found doing research in preparation for this transition to banking is that the quality of banking services in the minds of customers leaves a lot to be desired. And that really is the opportunity. So for us to be successful long term and to be different, we will have to bring to the market, to the customer, a service proposition that he or she really appreciates as distinctive. That's one. The second thing that will make us different and which we are determined to pursue is to deliver this quality of service, a differentiated quality of service at the lowest possible cost.
So technology and digital space, is that going to be helpful in acquiring clients at a lower cost for you?
Absolutely. So using technology intelligently at scale to drive costs down and enhance the customer experience, that is our objective.
So what is the kind of mix that you're looking at going forward between wholesale funding and retail funding? Because with the smallish number of bank branches that you have, digital space is what you're banking on a lot. Retail funding would take some time to kick in. Till then, what could be the requirement of cash and how are you going to fund it?
So we'll continue to fund our balance sheet the way we've been funding it so far for a transitional period until such time as it takes for us to build a depository franchise. Depository franchise will take years, will take 5, 6, 7 years for us to build. But I think we will get our fair share of the market for two reasons. One is that the overall financial system is growing. The country growing at 6-7% a year in real terms means that in nominal terms, our financial system, even in bad years, grows at 10 to 15%. So there's growth. There are new people with savings that are coming into the system all the time. We aim to get a disproportionate share of that expanding market, and we aim to take away market share from existing players whom we aim to beat on our customer service proposition.
So basically there'll be a lot of cannibalization also in this space.
Cannibalization, there is not the right word. There will be healthy competition.
All right, but you said that it will take a few years for this
Yeah.
whole digital retail proposition of yours to really turn around. Till then, the cost of funding will be on the higher levels?
Not much higher than what it already is. So, people don't fully appreciate that we are a fully functioning business generating, 15, 16, 1700 crores of profits annually. And that business is funded, which is a large business. We have a 70, 80,000 crore balance sheet, which is funded largely through the bond markets. And so in the transition, that source of funding will not become any more expensive. And for the time it takes for us to build our depository franchise is how we will, shift the weight from one leg to the other, if you like.
So what is the kind of return on equity that you're looking at from the beginning as you launch?
From the beginning, our return on equity, our return on equity currently in the business is not compellingly high, I have to admit. And one of the reasons for that is that we are extremely well capitalized, which, as it turns out, has been to our great advantage, because notwithstanding the stress that the infrastructure space has been seeing, our balance sheet remains extremely strong. But one of the consequences of having 21% capital adequacy is that the return on equity is lower. Our current return on equity is about 12%. I expect that as we transition to the bank, this return on equity will dip somewhat. But
To
over,
about?
I can't predict a number, but it will come down,
But what are the comfortable levels that you'd like it to be at for the comfort also of the shareholders, because it will be a listed company?
It'll be 8-9%. 8-9% is what it'll dip to. And in 5-7 years, we will deliver a return on assets and a return on equity that should be in the top quartile of the banking system.
Which would be up to 15?
It will be between 15 and 20, and a return on assets which will be closer to 2%, 1.5 to 2%.
How many years of pain do you see in this whole transition that you're going through right now? Because your operational cost has increased. It has hit your profits also in the last few quarters. Of course, it's front ending, so it won't sustain for too long. What are you spending most on, and how long will this continue?
So, our spending is escalated permanently, because we've gone from 300 people to 1,200 people by October 1st. And this 1,200 person workforce will increase to over 2,000 people by March. So operational spending is a step function increase, right? It's really the cost of operations relative to the business that we are able to generate is eventually the metric that we are focused on.
So what is that percentage that you're looking at for currently that
So the goal is, and our expectation is that within 5 years, our cost to income ratio should be 30 to 40% less than the best in class in the banking system today. And we will be in 3 main business segments. One is the commercial wholesale bank. Second is the personal and business bank, which other banks call retail banking, consumer banking, whatever. And the third one is what we are calling rural or Bharat banking, right? If you take each of these 3 segments, our goal is that our cost to income ratio in each of these 3 on a standalone basis should be 30 to 40% less than the best in market in the business today.
That's an ambitious target. How much time? You said 5 years for that.
5 years.
What is the mix between these three segments that you ideally want to have, and what is the timeline when you're going to really judge where it stands between commercial? Because right now 80% of your book when you start the bank will be on infrastructure lending.
Yeah. The world changes on a dime, so it's not helpful to me to put certain targets out there in the public domain and then have you ask me 3 years from now, oh, but Mr. Lall, you had told me 3 years ago this is what you're going to do, and now this is where you are.
But we should also have some milestones to look at.
But broadly, I think the direction is very clear, that the share of the wholesale and commercial banking in overall book size and contribution to profits will come down over time. So today, 95, 98, 100% of our profits come from the wholesale bank, right? I expect that 5 years out, the contribution of a wholesale bank to our profits will be between 80 and 85%. So now if you ask me what would be the contribution of these three businesses 5 years out on the basis of customers, I can tell you that 90% of our customers will come from Bharat Banking, or 80% of our customers will come from Bharat Banking.
But the profit contribution would not be as high. Yes.
And I can give you a sense for our targets for customer acquisition, right? Yeah. Our goal within 5 years for sure is to have at least 15 million customers. 15 million customers from zero today. That's how, what the scale of the rollout and the ambition is. And all this will be done profitably, right? So we'll be making profits every year. With what I'm saying to you is that although my ROE might dip, but every year, year on year, our goal is to increase our profits.
Okay. By
every
how much
year
are you targeting?
I again will hesitate to give you a number.
But still a ballpark.
But okay, I'll give you a broad range. If we are not able to do this at least 10-15% a year, I'll be disappointed.
Okay. And a large part of that profit contribution and the hike in profit that you are aiming at would also come by diluting the concentration to the infrastructure lending side, where you have seen many NPA situations which you are aggressively trying to bring down as well before the launch.
Yeah. So what happens 5 years from now in infrastructure, nobody really knows. But what is plain for everybody to see is that last 3-4 years in the infrastructure business have been very painful. But it is possible. I hesitate to say how probable it is, but it is possible, it is entirely possible that 2-3 years from now, the infrastructure business actually begins to pick up. Were that to happen, our historical franchise would become extremely profitable. And that's because we have gone out of our way to very transparently clean up our balance sheet before we launch the bank.
I have two questions on this. First, what makes you say that in 2-3 years, because you're so closely working with the infrastructure sector, you'll have a better view than any of us. So 2-3 years, you're saying infrastructure may pick up. Of course, government spending is something that we're looking at. Private spending would come, follow the government spending, but all of that still is at a nascent stage. We haven't seen the green shoots really. What makes you think in 2-3 years that's happening, and what are those factors that you are closely scanning?
I'm not banking on it.
All right.
My business plan, which I haven't shared with you, my business plan does not count on a recovery of the infrastructure space. So we are building our business independently of that. What I'm saying is, were it to come back, it would really be icing on the cake for us.
So you are not projecting any
I'm not.
revival? You're yet.
To be
not
very
yet.
honest. To be very honest, as of today, I cannot confidently project when the private infrastructure business will come back in this country.
All right, so you have therefore taken such aggressive steps, more than any other private lender right now, to clean up the balance sheet. In fact, so much so that the markets were clearly surprised last time in the quarter when you had taken a huge write down on account of power sector. Is more left, or are we done with it?
No, so the idea is that this quarter will be the last one where we do an aggressive cleanup. And that's the last quarter before we become a bank. We are taking, close to 2,500 crores of provisions.
Yeah, that yet.
And we'll just do that.
So 4,500 crores from the reserves that you are taking on account for the known stressed assets on your book.
Right.
And that will be the end of it, and you are very aggressive in it compared to the others.
Yeah.
Why no cautious stance like other private lenders?
See, our situation is very different from other banks. We are in this very unique phase of transition. So IDFC Limited will own 53% of the bank, and 47% of the bank will be held directly by existing shareholders at the moment of listing.
Yes.
But the moment the bank lists, right, shares will exchange hands.
Yes.
And what will happen is that 47% equivalent of the ownership of the bank could be held by shareholders that are quite distinct and different from the shareholders of IDFC, right? For us, therefore, as we are starting the bank from scratch, we had to make an aggressive effort to start with a clean slate.
Yes.
So you don't want to handicap new shareholders that are coming into IDFC Bank with the problems of the past. Hence our opportunity to clean up our book before the launch of the bank.
Of course, why I asked you also about the aggressive, provisionings that you have done, because the stock has become very cheap in the last few months. The foreign shareholders and investors' interest in a private bank, which is set out to launch, is not as high as it is in other private banks. And so much so that your valuations now are comparable to PSUs rather than the private sector banks. So therefore, is there any sense of comfort that you can provide to the shareholders and the foreign investors for them to look at it once again?
Yeah, so all we can do is clean up our book.
That's factored in.
Yeah,
and
well, I'm not sure how much that is factored in, because there's always could be a lingering doubt in the minds of investors. They would like to, make sure that that the cleanup we have done is actually sufficient, and that confidence is, confidence is a very, ephemeral thing. We can only do what is within our control.
I'm sure as a lender, and you did say that the term loan period would come down and infrastructure will get diluted over time. So in commercial lending, which are the three sectors that you would be chasing for lending into those sectors?
I'm not looking at it from a sectoral perspective. I'm looking at it from the perspective of underserved customer segments. The ease of doing business is not so important for the big corporates. Much more important for the smaller entrepreneurs. How do you make life easier for them to set up a thriving business?
But that won't be too large in
you'd be surprised. Anecdotally, just think about it.
So volumes would be higher, margins would be thinner?
No. Margins in this will be much higher than serving a large corporate. Because a large corporate, rightly so, is spoiled for choice. Large corporate can not only go to any banker that they want to, they can go to international bond markets. That's why, margins in that business are being driven down to wafer thin. So imagine, why I don't want to let too many cats out of the bag, but there is this very vibrant customer segment in our country that isn't a fully formed formal business person, that actually mixes up their private lives with their business lives. You go to any bank today, these customers either are force-fitted into some HNI personal banking category, or they are thrown into their corporate banking SME category, right? But that's not how they run their lives, right? So if as a new bank, I can give them a value proposition that delivers them convenience and support and access to products and credit in a way that is really useful for them, I can build a very valuable business.
So of course, while we spoke about the retail business and the wholesale commercial business as well, but your other counterpart, the new one, new kid on the block, Bandhan Bank, is focusing so much on rural banking. What are your plans in that area?
Our goal is to really learn from microfinance and from Bandhan. We want to take this service to the community. And you can do it today because the technology exists. So you really don't need a branch for too much. You have a branch as a hub, which is really a business servicing center more than anything else, and a back office of kinds, right? But you have customer service or relationship officers, loan officers as they used to be called in the old days, who with handheld technology can actually take the service to the village community and transact whatever it is they want to do pretty much in their angan, right? So I can open an account within 15 minutes now in the village. And in between my visits to the village, if you wanted to transact with the bank, I could actually go to a cash in, cash out point, which is in your neighborhood. And then when I want to borrow, IDFC Bank loan officer is coming to see me at least once a fortnight. And this can be done at very low cost.
What are your plans on the payment bank side?
So on the payment bank side, we are an investor along with Mr. Dalip Shangvi in his payment bank, and Uninor, which is the subsidiary of Telenor. So really, the idea is to work in complementarity with that payment bank to effectively complement their customers with banking services and be able to deliver our customers a greater ubiquity of presence without having to create our own branches. So I think it works extremely well.
You say that you want to keep the cost low, but you also aim, and that's quite an ambitious target, of 15 million customers in 5 years. Is there going to be premium pricing to acquire customers as well? Some of the smaller private sector banks have tried to do that, but not too much effect.
No. Pricing is a short-term game. Much harder, and that's why I'm not at all minimizing the challenge we'll face in doing it. Much harder, but much more effective, is if you can convince the customer and make them believe that your service is actually significantly more convenient and superior to the competition. That's how you win the game.
Ease of doing banking in India is what you're
doing banking.
Is what you're banking on.
Yes.
All right. Thank you so much.
Thanks.
Thanks.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.